Time to get you a fundamental view in the market as well, and joining us live on Street View at Lunch is Chokkalingam, Executive Director and Chief Investment Officer at Centrum Wealth Management. Chokkalingam, what according to you explains the weakness that we're seeing in our equity market today? Because the GDP number, while it's under 5%, the lowest in a decade, it's in line with what the market was expecting.
Basically, it has to do with currency depreciation, because 5% depreciation in a month's time has given little doubt in the minds of the investors whether there could be any risk from FII selling. According to me, definitely the market would recover probably today or next week, because though the rupee has depreciated by 5% in the last 1 month itself, and in a 2-year basis it has depreciated by 20%. Tactically speaking, most of the FIIs are tied to the Indian market, because if they start selling, the rupee can crash anywhere around 60 to 65, and nothing would be left to the FIIs to take away from the country. So therefore, tactically, I firmly believe that they are tied to this country, and therefore there is not much risk of FIIs selling. And even on the GDP, it is on the expected line. Definitely, I firmly believe that the reversal of interest rate cycle would continue, although the RBI keeps saying that there is upside risk to inflation. We have seen same RBI cutting down the interest rate by 125 basis point in the last 1.5 years. So these two would provide a good trigger to the market. And also the domestic institutions have sold more than 1 lakh crore in the market since Jan 2012. I firmly believe that a day would come and their selling would stop, and they would get attracted to the market. So that would provide another major trigger to the market. So therefore, we start using this kind of correction to buy good stocks in the market.
Chokkalingam sir, how would you approach the market right now? What suggestions would you give to your retail clients? Would it be prudent to stick to defensives today as well? You're seeing a good move coming in on Unilever relatively, as well as Infosys. Would that be the call until the market settles down a bit?
In fact, we have been selling in FMCG. Valuations are highly stretched, so investors should be very cautious. We have seen every time when the sectoral boom happens, whether it is a dot-com boom or realty boom, investors should not be carried away by the valuation, abnormal valuation, and this is the time to think of selling FMCG. Definitely one can go overboard on Infosys as well as Oracle Finance. We have been buying these two stocks because their recent depreciation also is positive, and in fact it would be a defensive against any possible further erosion in the exchange rate, because according to the World Gold Council, there is an expectation that gold import can be more than 100% in this current quarter. So if government doesn't do anything on that front in controlling the import of gold, then there is a risk to the currency. So therefore, IT measures like these two would be very defensive. Even in pharma, one has to be a little cautious. Many large cap pharma stocks have run up. So what we advise is that go for large cap stocks in the metal space, and also in the IT like Infosys and Oracle, and also look at the capital goods sector, because that has been suppressed for the last 5 years. So these are the three sectors we go overboard, and also as usual we pick up good value stocks in the mid cap space.
What about auto stocks, especially in M&M and at Tata Motors? What would be your call on these two counters, Chokkalingam?
We suggest to hold on M&M because of the management's superior quality. Otherwise, in the large cap space, we started building our position in Bosch Limited. It's a great value stock in the auto space. And also we look at auto components which are suppressed and they failed to join the large cap auto stocks. And we picked up JK Tyre in the last few days. We continue to buy even today. The stock is quoting around 2.5 PE. And if you look at the last 10 years advertising expenditures, which is almost close to the current market cap. So, and they have been doing extremely well in Mexico. And on a capital employed of 170 crore, they have done a profit of 129 crore in Mexican operation. So this kind of great value pick we are doing in the auto space.
Chokkalingam, just a word on the PSU banking pack, because that, after a disappointing set of earnings from each and every counter, in particular SBI, has really been reeling under pressure. Would you stay away from this space, or is it good time to now put in your money?
I would continue to stay away. For last 2 years, I have been staying away from most of the PSUs. Because what RBI has proposed is really terribly negative for the PSU, because their restructuring asset size is huge compared to the private sector banks. They would be in deep trouble starting from the next quarter, since they have to increase the provision for restructured assets from the June 2013. So I would advise to stay away from most of the PSU banks stocks. Probably one can do one or two value pick, something like State Bank of Bikaner, because the SBI has mentioned that in the media they may consider merging the associate bank with SBI, and some of these associate banks are quoting deep discount to their book value, adjusted book value. So except stock like State Bank of Bikaner, one or two stocks, I would stay away, and I would continue to advise sell on PSU banks.
Chokkalingam, you were talking about Infosys as a stock that you like. Do you think it's your top pick in the IT space? Would you prefer it over a TCS despite the superior performance of TCS? And are you not worried about the poor management performance?
Certainly, I think you are right, but I firmly believe that it is in the valuation. It is cheaper than TCS, and secondly, I mean, there has been so much of criticism. Let us look at Hindustan Lever. There has been so much of criticism before the quarterly results, and the company has come out with a buyback and helped the shareholders to create further wealth. And there is so much of negativism on Infosys. I think tactically also speaking, apart from valuation, where the stock is trading at a 13 PE on 1 year forward earning, tactically speaking also, they should listen to the media and the shareholders' criticism, and I am very confident the kind of cash they are holding and with the kind of advisors they have, they can surprise the market. Even otherwise, apart from the valuation, as I mentioned, the rupee depreciation also would be positive, so that would also help Infosys. So I would suggest Infosys as well as Oracle Finance. Pre-OFS, that stock has been hammered. Of course, it has recovered, but still it has not recovered fully the fall before which happened, during pre-OFS offer from the company. So these are the two stocks I feel highly quality stock in the IT space, and I would definitely recommend buy. And I am very confident that these two stocks can give anywhere around 15% return in the next 3 to 6 months itself.
Chokkalingam, let you go on that note. Good to have you on the show as always.